Today, we will discuss about monetary policy. Monetary policy is the process by which the monetary authority of a country controls the supply of money. Basically, there are two types of monetary policy. One is the expansionary policy and another one is the contractionary policy. Expansionary policy is the increases the total supply of money in the economy more rapidly than usual. Contractionary policy is the expand the money supply more slowly than usual or even shrinks it. If government apply expansionary monetary policy, then inflation problem may arise. Remedial measure is that induce a contraction in the supply of money and therefore spending by increasing the interest rate. For control money supply, government sell bonds in the open market. If government apply contractionary monetary policy, then unemployment and deflation may arise. Remedial measure is that induce an expansion in the supply of money, and therefore spending by reducing the interest rate. In this criteria, government buy bonds in the open market.
In open market operations, the government bought and sold securities by the Reserve Bank on secondary markets. Open market operations aim to manipulate the short-term interest rate, manipulate the supply of base money, control the total money supply. Open market operations works buying securities from commercial bank. It works by buying securities from public. Another way to working, selling securities to commercial bank. Last one is that, selling securities to public. Another important tools of monetary policy is that, required reserve and discount rate. Required reserve, a certain fraction of deposits that a depository institution is required to reserve. Discount rate, the interest rate charged by Federal Reserve banks to depository institutions on short-time loans.
Finally, goals of monetary policy is that price stability, high employment, economic growth, financial market stability, interest rate stability, stability in foreign exchange market.